for being a part of this live webcast. It's important to note that the purpose of this call is not to provide tax advice. Our objective is to provide you with an overview of how this new tax law could affect the investment real estate market. Myself, John Chang, and Matthew are not qualified to provide tax advice, though I believe Mr. Donofrio is a little more qualified in that arena. If you have technical problems on this, if you're dialed in but have technical problems and want to send an issue that you're having to the Q&A box, we've got somebody monitoring that, and we'll try to take care of you. Also, if you're registered for this webcast, you will be able to replay the presentation. So we ended up with well over 8,000 people that were registered for this webcast, which is fantastic. And myself and John and Mike are all calling in from different cities. I think we've got Phoenix, DC, Miami, all calling in. So we're trying to pull this thing together and move it forward as quickly as we can. Before we get started, let me take a minute and have our guests provide a little bit of background about themselves and a company and organization that they work with. Matthew Berger, if I could start with you, tell us a little bit about MHC and your responsibilities there.
Sure. Thanks very much, John, and it's a pleasure to be here with everybody this afternoon or late this morning, as the case may be, because I do realize that Washington is not the center of the universe, and far from it. The National Multifamily Housing Council is really the place where the leaders of the apartment industry come together to guide their future success. With the industry's most prominent and creative leaders at the helm, NMHC provides a forum for insight, advocacy, and action that enables both members and the communities they build to thrive. As part of our mission, we have an extensive advocacy arm, and I'm the tax lobbyist at the National Multifamily Housing Council, and my role is to represent the key owners, developers, and managers of the industry before the Congress and the Treasury Department and the Internal Revenue Service here in Washington to make sure that we get favorable tax outcomes for our members and to make sure that we can develop, manage, and operate multifamily housing in a tax-efficient manner and put the roof over the heads of 38 million Americans.
Thank you, Matthew. And just as a side note, the NMHC, Marcus Millichap has always been very active with NMHC, and they were instrumental in a lot of what took place in Washington, D.C. over the past few months and protecting the interest of a lot of the investment real estate owners. Mike Donofrio, Engineer Tax Services. Can you tell us a little bit about your company and what you're doing there?
Absolutely. Thanks, John. Happy to be here. We've been doing a lot behind the scenes. Thanks also to Matthew and his team and John and the Marcus team, working to make sure that the tax policy really benefits not just the largest corporations and REITs and investment groups across the country, which we also work with, but the local property owners, investors, from multifamily to industrial and retail and distribution and the corner coffee shop type owners. We work to really make sure the tax policy was benefiting everybody. I'm managing director with ETS, Engineered Tax Services, a unique engineering and specialty tax firm based in Palm Beach, Florida. My team works across the country with all different types of property owners, very savvy CPAs, investment groups, who wanted to participate in this call to get some guidance on ideas, strategies, what's new, what's changed, and maybe how we can help. But John, thanks, and look forward to this call.
Thank you. Thank you both. Before we get too deep into the tax reform, let's set the stage by looking at the overall economy and kind of the strength of the current economy and what the direction we're currently heading. John Chang, if I could turn it over to you.
Thank you, John. Part of the underlying strategy of doing tax reform was to build economic growth in the U.S. And as we get started, I kind of want to lay a backdrop of where the economy is right now and what we can expect as we go forward. Very quickly, I just grabbed a few high-level perspectives for our clients to understand just where we are in this cycle. So we have on the screen the employment growth drivers and numbers on a quarterly basis, looking back all the way back to 2000. We've been averaging close to 200,000 jobs per month continuously for 87 months. We've added jobs every month for 87 months. That's the longest growth cycle that we've ever experienced in the United States. We added just over 2 million jobs last year. We're expecting another 1.8 million jobs to be created in 2018. And a key factor there is that the unemployment rate is now down to about 4.1%, which is exceptionally low. Even the long-term unemployment rate is down to 8.1%, which at the height of the recession was at 17.5%. So we've seen this great movement. We've got a lot of jobs created, 17 million jobs created in this cycle. And that's very supportive of not just apartments or any individual segment of real estate, but it is supportive of the entire economy as a whole and all sectors of commercial real estate. So this is a big tide that's lifting things. We're not anticipating anything to be a barrier for employment growth this year, except for availability of qualified labor force. There's about 6 million jobs available right now. That's right in alignment with peak levels. So there are a lot of opportunities out there, and this could start to spark some wage growth and a little bit of inflationary pressure, especially with the stimulative effect of the new tax laws. So when we look at economic growth, we can see that it's been trending favorably, right in that 2.5% to 3% range. The other key ingredient has been consumer confidence, as well as small business confidence and CEO confidence, which are all extremely elevated right now. Some of them pushing to the highest levels in nearly 20 years. Now, part of that might be because of the anticipation of the tax law changes. Part of it is because of the great employment market. Part of it is because of the momentum we're seeing in the economy just in general. But confidence leads to economic growth. It's supportive of that. It's supportive of retail sales. And here you can see in this slide the growth of retail sales over the last 15 years, and how even on an inflation-adjusted basis, total retail sales today are 14% higher than they were at the prior peak prior to the recession. So we're seeing this momentum build. It's affecting all areas of the economy. It's employment. We're starting to see wage growth. We're seeing that economic momentum. We're seeing retail sales, and this is all culminating to support the commercial real estate sector.
So
John?
John, in kind of summary, we're looking at continued steady job growth, 4.1% unemployment, consumer confidence at its highest level in 15, 20 years, and GDP continuing to be stable. So, it sounds like the basis that we're working from, obviously, we're 8 years into this economic cycle and things have been moving very positive, are that we are in a very strong, very stable place from an economy standpoint. So if we could now take it to how does that apply to our new tax law, and how have things changed within the tax law?
Sure. Thanks, John. Matthew Berger for NMHC. When we first started this process, many of us were very worried that tax reform would be quite disruptive to the industry, to the real estate industry writ large, if not handled correctly. I think most people will be very pleased to learn that the tax reform bill turned out quite favorably for the commercial real estate industry, and we just wanted to spend a couple minutes going through the key provisions that will really demonstrate how business models largely won't change, and how capital is going to keep flowing into the industry and won't be disrupted by the tax provision. So first and foremost, we're very pleased to report that the new Tax Cuts and Jobs Act retains like-kind exchanges. Under prior tax law, like-kind exchanges were available for all property held for investment for use in a trade or business, be it real property or what's known as tangible personal property. What's really nice is that the tax law retains like-kind exchanges for structures, which is going to really help make sure that money keeps being invested in the real estate sector.
So, Matthew, real quick, can you give an example of a transaction that would have qualified as a 1031 exchange with the old law but does not qualify with the new law?
Sure. The best example is let's imagine that you hold a fleet of rental cars. That's not going to qualify for a like-kind exchange. It's really going to have to be real property, namely structures. What's interesting about this, and we can get into this a little bit more, is that if you separately depreciate some assets within structures, those will no longer qualify for like-kind exchanges per se. But there's a great new provision, which we're going to talk about in a minute, which will effectively replace that. So the disruption from this little change is not going to be incredibly significant for the real estate industry, and we've really protected the real estate industry's ability to like-kind exchange the most valuable assets we have, which are the structures.
No, because the microphone is on for the computer.
Next and most importantly, we also wanted to talk through the deductibility of business interest. As everyone well knows, real estate is very rarely paid for fully in cash. I mean, people borrow money to purchase and develop real estate. In the multifamily industry, for example, it's very typical to have a deal which is 65% debt and 35% equity. And unfortunately, nobody lends money for free. Under the old tax law, business interest was fully deductible as an ordinary and necessary business expense. Under the new tax law, the Congress has seen fit to curtail interest deductibility based on somebody's earnings before interest, taxes, depreciation, and amortization. What's really great, though, is that we were able to secure a carve-out for real estate because real estate is so capital intensive and generates so much interest. So the tax law will now allow real estate companies to fully deduct all their business interest. There will be a slight consequence for that because it's going to require slightly longer depreciation periods for buildings, which we can get into in a second. But where the money is, we've protected the full deduction.
And Matthew, from that standpoint, real estate companies, does a typical real estate partnership qualify as a real estate company?
Indeed it does, John. The law is written very broadly, and for purposes of the provision, a real property trade or business is really going to mean any real property development, redevelopment, construction, reconstruction, acquisition, conversion, rental, operation, management, leasing, or brokerage. So it's really broad. And what's also really nice is that right before the bill passed the Senate, there was what's known as a colloquy between Senator Hatch and Senator Langford of Oklahoma, which would also allow seniors housing to fully qualify for this. So they've really covered the entire waterfront here.
Great, thank you.
And Matthew, it's Michael. I just wanted to add to that. Even though the downside of electing the longer depreciation class size, electing the ADS or alternative depreciation system, if someone wants to elect to take that business interest deduction, what the savvy property owners and CPAs will still do is they'll realize that they can do a cost seg study to carve out of that 30 years for residential or 40 years for non-residential investment property and get your accelerated identified 5-year and 15-year class size. So there's still a great cost seg strategy, even if they elect that business interest deduction strategy.
Yeah, that's exactly right, Mike. So Mike is saying that let's just unpack. Let's just spend a couple seconds just unpacking these concepts. So if you under the old tax law, a multifamily building was depreciated over 27 and a half years, and a commercial building was depreciated over 39 years. Under the new tax law, if you elect out of interest deductibility, your multifamily building will be depreciated over 30 years, and a commercial building will be depreciated over 40 years. However, as Mike says, you've got a really great opportunity to break down some of the components of that building and get much faster depreciation on those components. So, Mike, why don't I turn it over to you? You can explain that on our next slide.
Sure. Okay, so I want to make sure the slide's on the right page there. So in essence, what a cost seg study can do, as Matthew had mentioned, is break out that 27. Let's talk about a residential multifamily investment property. Right now, those properties, you purchase a property for $1 million, $5 million, $10 million. whatever the amount is minus the land can't be depreciated. Then you have your building basis. That building basis gets depreciated out over 27 and a half years. But within that 27 and a half year period, or 39 years for commercial property, you can still carve out and identify through a cost seg study 5-year assets. That's personal property inside the building, ancillary lighting, electrical, mechanical, plumbing, security, IT, that kind of stuff, and certain amounts of improvements. And then 15-year property, which is land and site improvements, things outside and around the property, utility improvements, land and site grading, landscaping, lighting, signage outside the building. Those are just some examples of, even though you have, quote, longer depreciation class lives assigned to these buildings, through a cost seg study or component depreciation, you're componentizing that building, putting a big chunk of the property into 5-year asset class. So you're depreciating that over 5 years. Roughly 15 to 25% of buildings fall into that, and then 15-year class lives. So, even though, and we could do that retroactively on older properties, and then going forward, also we can do it on new purchases as well as new construction as well. So there's other new provisions for bonus depreciation of capital expenditures to potentially fully expense items. There's numerous restrictions and much more clarification and wording that we're expecting soon. But an important thing to remember is that bonus depreciation provision doesn't start January 1st, 2018. It's actually retroactive to September of last year, 2017. So we'll get into the specifics separately if you got any questions on that. But Matthew, does that cover it good, or anything else you'd like to talk about?
That's perfect. I think that should definitely cover the proverbial waterfront.
So one of the things to point out, I mean, the final regulations are not fully written on this yet, so there could still be some things that change within the new tax law. But as I look at this and what was just being discussed with the Section 179, I mean, that seems like it could be an enormous benefit for kind of the real estate investors, and I may be getting ahead of us a little bit, but as far as what
it's
this
a massive benefit.
That's something that could be really, really positive.
Yeah, absolutely, John. That Section 179. Many of your clients that are purchasing a property and doing renovations or improvements or value add, it's called, where they're putting in new countertops, new cabinet package, new flooring, new renovations for tenants. That new Section 179 and able to fully expense up to $1 million of that. Take note, though, the IRS has currently identified HVAC, roofing, security systems in non-residential properties. But we do expect further guidance on that, because it's strange that lighting was left out of that topic. But yes, bonus depreciation, as well as the retroactive applicability of bonus depreciation, as well as that Section 179, being able to expense immediately up to $1 million of new business assets. That's amazing. And final point on this, remember that bonus depreciation applies to not only improvements and new assets that are constructed into a building, but purchases of existing buildings as well. And that's a huge amount of the investment property trade that happens, is purchases of existing buildings.
Is that purchases beginning in 2018, or is that retroactive?
That's retroactive to September of last year. That's how amazing it is.
Okay, good. I mean, to me, that seems like a tremendous benefit to people that own investment real estate. That seems like not only is that going to improve the real estate, I mean, that's something that's going to stimulate construction and is going to create jobs. It's going to stimulate the economy. So to me, that seems like a tremendous benefit.
Agree. Yeah, as you and I have been educating folks throughout the country, last year you're going to see that uptick of increased expenditures into those improvements into that property, which puts the roofers to work, which puts the construction trades, all different architectural engineering trades to work on these properties, as well as the tenants and retail aspects of these buildings as well.
Great, thank you. John Chang, did you want to? I think you were going to go next.
Yeah. So while the emphasis of the whole webcast is really on the the investors in commercial real estate. We don't want to ignore other parts of the tax rules because they are coming into play and they are capturing so much attention from the media. We're going to touch a little bit on some of the highlights on corporate tax as well as personal tax, and I'll be going over those just at a high level, but we have a few insights that are fairly unique that we want to share with people. So the first thing is that when you look back historically, going back to 1950, where tax rates have been, the orange line on this graph, it's really hard to discern any relationship between the highest corporate tax rates and economic growth. But nonetheless, we can see that it's gone from around 50% tax rate maximum in the 1950s all the way up pretty much until the 80s, dropped down into the mid 30% range through the 90s and the early 2000s, and now we're pushing that tax rate down to 21% for corporations. Now there are huge questions about whether this will spark economic growth or whether the money will be put into dividends and stock buybacks and that type of thing. But as Mike Donofrio and Matt were pointing out, there are some very big depreciation rules that have been put in place that will be supportive of companies putting that money back to work. So in addition to the reduced tax rate, because of those bonus depreciation rules that are in place only for a short time, I think 4 or 5 years, 5 years for most of them, those will cause companies to invest some more of that money into the economy than maybe we've seen when we've done major tax cuts for corporations in the past. In addition, we have the repatriation of overseas capital by a lot of corporations, estimated to be somewhere in the $3 trillion range. We don't know, of course, how much of that will be brought back or exactly how it will be applied, but there is a reduced tax on those assets that are brought back into the States, and those will again maybe be used for stock buybacks or dividends or other things. But the benefits of accelerated depreciation that Michael and Matt were talking about may come into play to get more of that money pushed into infrastructure and development. When you look at the performance of corporations right now, corporate profitability is exceptionally high. It's nearly at its peak, and it's up about 6% on a year-over-year basis. Those are the gray bars. Fixed investment in equipment stalled out for a bit, but as corporate and small business sentiment has improved, we've seen actually growth in investment into infrastructure and equipment, and that's up about 6.2% over the last year, and it could continue to grow. So we'll have some economic growth that is sparked by corporate investment into all of these infrastructure, software, equipment that will support economic growth. It is not as big as a chunk of the economy as consumption, but if enough money gets put back into the economy through the stimulus, we could see the economic growth pick up a little bit over the coming year, driven by what's happening with the corporations as well as the consumers.
So that's interesting because I know, John Chang, you and I have looked at that graph quite a bit over the past several years, and we had a couple of what appear to be kind of false starts of increased fixed income into businesses and equipment. But obviously it's already turned, it's moving in a positive direction. And the thought is, with new tax law, with repatriation, and some of the benefits and bonus depreciation of that, we could actually see that that reinvestment back into businesses. We could see that number continue to trend up for the next couple of years.
Yeah, and I think part of it was also sentiment. I think in anticipation of more accelerated economic growth, that many corporate leaders believed that the new tax laws, the new administration would be supportive of business, and they had a stronger sentiment and started to reinvest a little bit more aggressively.
Great. Great, thanks.
Shifting over onto personal taxes, again, I'm not going to get into all the details. One of the things we did that was actually kind of interesting is we took the actual taxable income and applied it to marginal rates across the spectrum and added up a before and after scenario for both the single taxpayer as well as married filing jointly to see how much difference are we looking at in terms of tax savings based on the taxable income. Now, we have to point out the deductions matter, right? Because deductions got changed a lot. This is after all the deductions are taken out under the old rules and the new rules that were standard. Here's what's happening with taxable income, and both single and married filers see some benefit up to about $200,000. Then single filers actually start to pay more taxes under the new rules than they did previously until you hit about $500,000 mark, and then it starts to push up again. For married people, you can see you get a nice, a steeper movement between $250,000 up to about $300,000, and then it flattens out. So your tax savings between $300,000 to $400,000 or $500,000 is relatively stable, and then it picks up again. So this is something I hadn't seen out there before that I thought was very telling in terms of the effect on their personal taxes as a consequence of the law. But again, this is not this factors after the deductions are taken, and when you look at some of the deductions that have changed, they're pretty significant. Again, this is not a complete list here. This is just a limited subsection of them that I thought were most relevant to real estate investors. The personal exemption was removed. The limitation on state and local taxes with a cap of $10K on property and income tax and or sales tax at the local level, changes in mortgage interest deductions, and et cetera, are reducing the number of people who are going to itemize taxes given the elevated standard deductions that are in place now. So the standard deductions have been increased. There's fewer write-offs or limited write-offs that are out there. So people's taxable income in many cases could go up if they have historically itemized a lot of expenses, or their taxable income could go down if they're historically have not itemized a lot of their write-offs. Also, just a sidebar there, the estate tax limitation has been effectively doubled. So now you have far fewer people who are going to have to address estate taxes. Now with them at about 11 million and 22 million, that's becoming only affecting a very small percentage of the people out there. So all of these changes to the deductions, the increase in the standard deduction, and all of the way these things are changing, and the layout of the taxes will change behavior. Okay, people will behave differently because they'll work to take advantage of the tax advantages and mitigate the reductions. So, some of the things we may see include changes in housing behavior, that now that it's much more difficult to itemize homeownership, maybe we'll see a slight reduction in the number of first-time home buyers going out there to buy that first home because they're not able to write off the interest on the house because their standard deduction's higher. So they may stay in an apartment rental a little bit longer. With the removal of the personal mandate and the Affordable Care Act, there will be an estimated 13 million fewer people with insurance over the next 10 years. Compared to where we would be with the personal mandate, compared to where we are without, we may see a little bit less demand over the next 10 years in healthcare and medical related real estate demands because there will be fewer people using the medical services as much. Now, neither of these cases, housing demand or the effects of the personal mandate, we don't anticipate these to have a huge effect on the supply and demand of commercial real estate. I'm simply noting them as areas where you may see small behavior shifts that could affect performance of these assets over the longer term. So, John?
John Chang, it's Mike Donofrio. I just wanted to add a little specialty tax side note to your corporate and personal updates. We didn't talk about AMT, alternative minimum tax. I just wanted to make the point for the folks on the line so they realize that in this new tax policy, another big benefit for both on the corporate and on the personal side, AMT, alternative minimum tax, was repealed completely for the corporations beginning in 2018. And it was minimized greatly on the personal side as well. There's some specific language there, but it's minimized greatly through 2025. And what that means for those that know what AMT is, that were hit by it, it's kind of a complicated system, but it allows a lot more utilization of those expenses and that depreciation that flows through on the personal side. So I just want to make that note about AMT in case anyone was wondering.
And then, really, what just as a summary, John Chang, on what you just talked about. I mean, for the most part, the itemized deductions, the how this is affecting individuals, for the most part, that's very positive. I don't see anything in that. I think that that helps the economy. I don't know that it's a direct relation to real estate, but it seems like all of those things are pointing in a direction of benefiting the overall economy. Would you agree with that?
It's so hard to tell right now. So many people are still trying to come to terms with exactly what these changes will bring. For example, when you talk about the state and local taxes, there's many states where people aren't worried about a $10,000 cap because it's irrelevant. There's states, where the tax burden is very low. On the other end of the spectrum, you have metros in the Bay Area, for example, in the Northeast, where that is a very significant change in people's tax burden as a result of this. There may be a very localized effect. Generally speaking, my understanding is the majority of the people will see at least some tax reduction. For most people, especially those at the lower income spectrum, most of those savings are going to be spent and used for consumption, and that consumption will support economic growth. We just don't know exactly how big that boost is going to be.
Right. Okay. So, tax.
Yeah, thanks, John. So when we first started the tax reform debate, as I said earlier, many of us in the real estate industry and the advocacy world were very worried that it would not turn out as a positive for the real estate industry. I wanted to go through a brand new provision that we think is going to be extraordinarily beneficial to the pass-throughs that dominate the real estate industry, namely LLCs, S-corps, and partnerships and sole proprietors. Because whereas the corporate rate is going down to 21%, pass-throughs pay tax, owners of pass-throughs pay tax on the individual side of the code. And while the top individual rate is going down to 37%, there's still a very big delta between business income at 37% and corporate income tax at 21%. So what the advocacy community did is we encouraged Congress to provide pass-throughs with a real tax cut on their business income. And while the devil is certainly in the details, and this is a very complicated provision for which it will take several months to write regulations so that it works as intended, we think that the provision I'm about to describe will be quite beneficial to pass-throughs and really reduce their tax rates on their taxable income. So what this provision does is it provides a 20% tax deduction on a pass-through's taxable income. So that if you're at the 37% top marginal rate, you're effectively going to be paying 29.6% on your pass-through income. So I'm going to go through it very quickly, and I'd be happy to talk to anybody offline as to how the mechanics of it work, because it is quite complicated. But basically, for married couples earning over $315,000, their deduction is going to be limited to the greater of 50% of that person's allocable W-2 wages paid by the business, or, and this is very important for commercial real estate, 25% of wages allocated to that business plus 2.5% of the unadjusted basis of all qualified property. If you're under the $315,000 amount, these limits don't apply to you, and you get a 20% deduction. But we're going to go through how the deduction works on our next slide, because I know that's a mouthful. But I did want to mention that the deduction applies at the entity level, so it's done partnership by partnership, and then you aggregate your deduction amount on your return. And however, it only applies to property held at the end of the year. So if you sell a property before the end of the year, you're not going to get the deduction with respect to that property. However, the Congress has charged the Internal Revenue Service with making sure that if you do a like-kind exchange, you are still able to qualify. And in addition, income from trusts and estates are going to qualify, and all your REIT dividends are automatically going to qualify for the full 20% deduction. So let's talk about how this works in practice, because I know that I just threw a mouthful of basically tax gobbledygook at everybody. So let's imagine that a multifamily firm purchases an apartment building for $20 million, and $14 million of it is attributable to the structure, and the building generates annual rental income of $1.25 million. So before you even start thinking about the limitation, if the maximum deduction that you're going to be able to get is 20% of the income that property is throwing off. So 20% of $1.25 million is $250,000. So that's going to be your maximum deduction. Now, we got to calculate the deduction limitation, and unfortunately, the PowerPoint gremlins have slightly messed up our slide here, so I promise I'll get this fixed by the time it's sent out to everybody, so just ignore what's next to the check mark. But basically, the maximum deduction that you're going to be able to get is 2.5% of the basis of the structure. So it's 2.5% of the $14 million, and that works out to $350,000. So in this particular case, this taxpayer is not limited this person's deduction is not limited at all. This person is going to get the $250,000 deduction straight up. And what's really nice about this is that we were able to get that provision in there right at the end of the process that allows for very capital-intensive industries like real estate to qualify. Initially, the Senate bill simply was going to limit you to 50% of wages, and for very capital-intensive industries like real estate that have, have a lot of capital relative to wages paid, that really would have left many of our folks out in the cold, proverbially out in the cold. So we worked very hard to make sure that very highly capital-intensive industries would be able to qualify, and we think this, as long as the regs work out well, we think this will hit the mark, as this particular taxpayer would get a $250,000 deduction.
Matthew, it's Mike, and again, like you said, the devil's in the details to see which strategy here might be best for different property owners on different properties, given what is the rental income on a building, or are they more in a loss situation? Is it better to take more of a traditional route, do that cost seg study, take the bonus depreciation on the purchase that I mentioned, which could be significantly higher than this avenue. But again, that's where the devil's in the details, is you want to make sure you do some good analysis on what's the right strategy for each property, for each entity structure and investors. But that's what we do all the time, so happy to help there as well.
Yeah, that's a great point. The tax code is unfortunately quite complicated and very dynamic, so it certainly pays to look at all facets of it, and not get caught up in one particular provision. It really all does work together.
Well, and I think the other part of it is that this is not something you want to try at home. I mean, this is something that you definitely need to rely on the people that are experts and the people that make their living understanding this in detail and understanding how to work with the investors and what provisions are going to work best for them. So, and you're absolutely right. It's quite complicated, and we're kind of giving it a flyover to give people some ideas, but certainly not something that people could sit down and really figure out on their own, I don't think. What I wanted to do next is just touch a little bit on where the commercial real estate market is. And so we've talked a little bit about kind of the economy. We talked about the new tax law, how that's going to affect the investment real estate market. And just wanted to touch on, so how is, from a high-level perspective, how is commercial real estate doing? And the answer in a word is it's doing very well. I guess it's two words. It's doing, but it continues to remain very strong. You can see from this is construction trends, and you can see from this that primarily office and industrial have had tremendous construction growth over the past few years. Office has definitely started coming back a little bit in recent years, and I could see that continuing a lot. What I've seen happen over the past few years is a lot of the B and C space and office has been occupied, and that's created a greater demand for the Class A. So I wouldn't be surprised if we started seeing some more office construction moving forward. Retail, obviously going through a transition period. It may take a little bit of time for retail sector to kind of find out where that balance is between the bricks and mortar and the online. But retail overall is doing fairly well. And it is, especially in the higher quality locations in the triple net lease properties, retail is a, if you read the papers, you would think that it was things were really bad, but the reality is that there's certain sectors that have a little bit of struggle, and also anytime there's struggle, there's opportunity, and a lot of our investors are constantly looking for, where is that opportunity? Where am I going to be able to go and find an opportunity to turn something around? Multifamily construction will drop from about 380,000 new units in 2017 to about 335,000 new units in 2018. In large part, that's the result of lenders tightening their requirements for new construction loans starting in about the second quarter of 2016. So that happened second quarter 2016, and the 16 and 17 delivery numbers were already in the pipeline, and that already in 2018 that comes down just a little bit. If we now look at where vacancy rates are, operations on investment real estate have continued to do very well. Multifamily, retail, and industrial are all near 5% vacancy levels. All product types have seen vacancy rates decrease consistently over the last 7 or 8 years. Office vacancy is at 14%, but definitely much healthier than it has been in recent years, and you can see that trend has continued to move down. And also that office much healthier than where it was a few years ago. Multifamily vacancies ticked up a little bit in the past couple of years, and really where that has happened is the result of a handful of markets around the country that have experienced a high number of new construction Class A units that have been delivered into that market in a short period of time. There's one of the questions that I get a lot, that I'm sure John Chang gets a lot, is, tell us where there's going to be blood in the streets. Tell us where there's going to be, where the market's going to get really bad. I don't know that we're seeing anywhere right now. For the most part, even in a market, even some of the markets where there's a little bit of overbuilding, they've just gotten out over their skis a little bit, and assuming that the deliveries of new construction slow down over the next couple of years and job growth continues, then they will kind of catch up to where they were and continue to do well. Maybe in the next year, some of those markets, they may not hit their their pro forma numbers for the new construction. But once again, it's an extremely healthy market. And let's also keep in mind that 3 of the 4 product types we're looking at a 5% vacancy factor, so which is very, very healthy. This chart is looking at the total number of commercial real estate transactions, and it's broken down by tranche, the 1 to 10, 10 to 20, and 20 million and up. And the point to make on this is that the velocity, the number of transactions that have been taking place, has dropped a little bit in 2016, 2017. And there's a couple of points to make on that. I mean, first of all, the most important part of it is it dropped a little bit in 16, and it dropped it still forecasted because the numbers aren't all in, but likely drop a little bit in 2017, less than 10%, quite a bit less than 10%. And the other aspect of that is that you're still above the 2014 levels. So it has dropped a little bit. 2014 was considered a very, very strong year, and we're still above that level. The other part of it is generally velocity will slow down a little bit when the market fundamentals are diminishing, and that's really not happening here. Your market fundamentals are doing very, very well. So with that, let me, John Chang, let me hand it over to you and let you finish this slide.
Sure. So, one of the things that we've been looking at is some of the effects on investors. And as John said, we've seen a little bit of a slowdown of momentum in the transaction activity, and a big piece of that has been the tax laws. With these major tax considerations under debate over the last year, there have been many investors who've been waiting to see how this is going to pan out before they start making decisions. And we've seen that affect not just the transaction activity, but we've also seen a little bit of flattening of the yield for commercial real estate. Cap rates have been flattening. We've seen them edging up a little bit in some areas. There's been an opening of a bid-ask gap for some investors. So that's really flattened. We have also seen a little bit of upward momentum in the treasury rates. So the yield spread between the cap rates and the treasury rates has really actually been pretty stable over the last, over the last year to 2 years. Now, we could see this start to tighten a little bit. As we've talked about, the stimulative effects of the tax plan have the potential to start to support inflationary pressure, which could in turn boost pressure on treasury rates and interest rates. So we may see a little bit more movement on those interest rates this year. And that's part of what's making the timing for investors very important in the first and second quarters of this year. Because we haven't seen the big movement on those interest rates yet, we're starting to see some more information about what to look forward to in taxes, and we're supporting a position where people can start to make decisions based on what they see out there. So I think our next section is a place where we're going to be able to answer some of the many questions that have come in. We've had several hundred questions come in over the course of the call. And so, John, if you want to start to put out some of those.
Yeah, let me ask the first one. One of the questions that came in: will carried interest for the sponsor or GP on hotel real estate be considered long-term gains after 1 or 3 years under the new law?
With the guidance we're given now, it's 3 years.
So it would be 3 years.
Answer there. Yep. That's what we're being told. Okay. But again, note the caveat to what I'm saying. We do expect further guidance here soon from the IRS and Treasury on some of these points. I don't think that one will change, but some specific language on other things will definitely be needed here soon. But it's 3 years currently.
Okay.
Hey, Mike, you make a very good point. These are the ground rules, right? But we're still waiting for specifics from IRS, from the Treasury Department, and maybe even some edits to the tax law as we go forward this year. What kind of timeline do you anticipate these things manifesting?
Yeah, great question. And special thanks or shout out to my partner Julio Gonzalez and Gonzalez Family Office, who's been doing a lot behind the scenes with administration, Matthews Group, National Multifamily Council, the Real Estate Roundtable, the administration and their listening groups to hear what's really going on with the property owners, like the folks on this call. But the long-winded answer and the reason for the background is to say that we're being told directly from behind the scenes and also from the IRS directly that they're hoping the target is February to get some of the details out, because if they don't get it out quickly by early February, it's going to be impacting March and April tax returns and people's checks this year. So they need to get on it.
Great. Another question we've got for the 20% pass-through deduction. What is a pass-through entity, and would it include an individual private owner that owns an investment under his or her personal name, or does it require an LLC?
I'll take the first stab at that answer. Again, this is Mike, but typically most real estate investment property owners aren't holding property in their own name, although some do. Maybe they didn't know about the LLC structure or different pass-through entities or don't have partners in it, so they hold it in their own name. Currently, the way it's written, it does not work if it's held in your own name, but any other pass-through type entity, LLC, other partnership type structures would qualify for that pass-through deduction.
Yeah, that's our understanding as well. But again, the devils will be in the details once they put those out. You also likely have to be a trader business to be able to qualify.
That's a good point. And remember, most LLCs and partnerships and entities that are created would qualify as that trader business, because the trade that they're participating there is real estate investment sales.
Absolutely.
Next question: Are there any changes to the tax law that are particularly negative for real estate investors?
Whew, that's a good question. I mean, we get that one a lot. We've talked about it amongst ourselves. We haven't seen much, besides that the one issue we talked about to maintain that full deductibility of interest and that slightly longer ADS method for depreciation. But remember, you still can do the cost seg on all those properties as well to carve out that personal property. That's the only slight negative that we've seen. There is a workaround or other strategy that you can deploy. We haven't seen any other negatives. So thumbs up to the new tax policy on that one for real estate investors.
Well, all the trade organizations, all the trade organizations, NAIOP, NMHC, ICSC, I think they did an outstanding job of defending our industry in this process.
Absolutely. There was a lot going on behind the scenes. Like I said, especially Matthews Group, and NMHC, Real Estate Roundtable, the ICSC, you name it. They were really putting out the word as to what is important for the average property owner and business owner in this, an investor in this country. So lots of positives.
This is a pretty good question. So how long, actually, I think you just answered this one, Mike. How long until the Treasury Department and the IRS come out with additional guidance? Will it come all at once or in piecemeal? And you're saying that they're kind of shooting for February,
yeah,
is that right?
Yeah, it's targeting February, but if we look back just a few years ago, there were some regs that were changed called tangible property regs, which was substantial changes to the tax code, not as substantial as what we're talking about here, but initial guidance came out a few months after. But it, honestly, it could be another year for the rest of the details to come out. But we need further guidance within the next month or so. But if I was a betting man, and I've been known to be here and there, it's going to be at least a year or so.
Yeah, I mean, I was talking to a friend last night, and we were sort of drawing an analogy between the Dodd-Frank process and the tax process. And it depends on what provision you're talking about. Some of them will be prioritized for regulations to come out sooner rather than later. But I would expect to be seeing regulations a year from now on the less high priority provisions.
And I believe we already touched on this one as well. Go ahead, John.
Oh, John, I was just looking through the questions as well, and there seems to be a little bit of confusion among some of the people on the webcast between their personal property taxes, which are restricted under the new laws, versus the ability to deduct the taxes on commercial properties. So, Matt or Mike, do you want to give a quick clarification there?
Sure, I'll take a stab at this one. So I think what the questions are getting at, please correct me if I'm wrong, is on the personal side, there's a $10,000 limit with respect to state and local income and property taxes. That $10,000 limit is not going to apply on the commercial side with respect to property taxes that are paid for by the entity. So you're going to be able to fully deduct those property taxes. Now, in some states, income taxes is my understanding, are paid for at the entity level. In some states, they're not. With respect to income taxes, those that are not paid for by the entity level, those will be subject to the $10,000 limit. However, the property taxes should be just fine and fully deductible.
Okay, Matthew, that's our understanding currently as well. Again, some things are subject to change at the state level. Who knows how states are going to react to some of the, and local municipalities are going to react to tax policy over the years, because they're going to want their fair share. But that's our understanding as well. So again, another win for commercial and residential real estate investors.
Great. We've only got a couple of minutes left. What I'd like to do is just go to the kind of the final slide that gives us kind of the impact, kind of a high-level overview of the new tax law on commercial real estate investors. And John Chang, if I could hand it over to you to do that.
Sure. So we have lower tax rates out there, and again, we're not able to quantify this yet, but we believe there will be some economic lift from this. And from our perspective in the industry, we've just extended the growth cycle and extended extra innings, if you will, for commercial real estate. It could give it a little bit extra boost even, and make it a little stronger than it has been. But for the industry as a whole, the economic lift should be a positive. The clarity on the real estate taxes is making decision-making easier for investors. As I mentioned earlier, there's many who sat on the sidelines waiting to see what was coming out. We got a very beneficial result with the retention of 1031, with mortgage interest deductions, depreciation, bonus depreciation. A lot of things came out that's very favorable, that investors can now start to make those decisions about what they want to do with their strategies for their investments over the short and long term. This could also support market liquidity with the after-tax yields. Because of that 20% deduction on pass-through entities, it makes the yields on commercial real estate particularly appealing compared to other asset classes. So those after-tax yields are a key ingredient for investors now, and it could draw additional capital into the sector. We could see much more passive investment coming into the market through funds, and that will continue to support values for assets, continue to strengthen the pressure on the yields. So this could be a very dynamic investment market over the coming year, as more and more people who are not already in the industry start to see the benefits of what commercial real estate offer. But again, as I mentioned earlier, with stronger economic growth comes some risks. We will likely see a little bit more inflationary pressure, a little bit more interest rate risk in the coming year. And that makes timing become that much more important. If we start to see the stimulus of this of the new tax laws pushing the economy aggressively, we may start to see the Fed put the brakes a little bit on those interest rates, which will then raise the cost of capital for investors. So these are key ingredients that we need to consider as investors looking forward into 2018. But I think overall we're in a very, very favorable position. John?
Thank you, John. If you wanted to put this last slide up, if you have further questions regarding the cost segregation, welcome to contact Mike Donofrio. As you could, as he starts talking about that, you can tell he's got an amazing depth of knowledge and has a large national company behind him. But in summary, let me just thank, and on behalf of myself, on behalf of John Chang, everybody at Marcus, Millichap, and our clients, I do want to thank Mike Donofrio of Engineer Tax Services and Matthew Berker of NMHC for participating in this live webcast. Appreciate all the questions. We had almost 500 questions that came in, so we just did not have time to obviously get through all of those. Want to thank all of our clients and friends for joining this call today, and I want to wish everybody a healthy and prosperous 2018. Thank you.